Hello, everybody. Welcome to Agoric's Pillar Series. So as a reminder, I'm Rowland, product lead at Agoric, and we do a pillar talk once, roughly every month or so, usually around topics that are a little outside of our normal speaking engagements, a little less technical, maybe more market focused. And today I'm going to do an intro to DeFi. Our hoped for audience for this talk are developers or people who have observed the DeFi ecosystem from the outside, but either have only started to wade in or are potentially learning about some of the core concepts still. So if you're a crypto native, if you're aping into unaudited contracts that are 30 minutes old, this talk is probably not for you. We'll have content for you later on. But I'd love to take you through this intro, and during the talk, please send questions in. I see a number of you in YouTube, so I'm sort of managing everything. I'm doing the YouTube stuff. I'm doing the deck, so I'll be back and forth. But would love to take live questions if you have them. So with that, let's talk about our goals. So I said already this is an intro to DeFi talk, and what I'd like to do to start with is frame the DeFi movement. Talk about what are the problems it really solved? Is it solving real problems, or is it just a bubble? Talk about some of the use cases that are involved in DeFi. And then we're going to dig into two specific use cases, lending and automated market makers. And my goal with that is really just to scratch the surface of some of the core concepts, penetrate some of the language. DeFi, as you know, has some of its own intricate language around certain mechanics. So I'd like to talk through some of those, and then suggest a few future directions for those areas. And then beyond that, talk about what it might look like to launch a DeFi product, some things to think about if you're looking to do that, and then how Agoric can help and why we think Agoric is a good place to be doing that if you are launching a project. All right, so with that, again, happy to take questions as we go. I will stop at the end, but please stop me and I'll go back or elaborate on additional concepts. All right, so what's happened with DeFi over the past several years? This graph shows the Ethereum locked in DeFi contracts, which is really just a measure of how much attention is in this area, how much funding has really gone in. So this is not ETH that has been sold for DeFi. This is ETH that is being used to lend out or do some of the other things that we're going to talk about in the use cases later. You see this chart often shown in dollars, and I like to show it as ETH just to sort of pull out the dollar value going up as part of it. But even really the reality is somewhere in between that, right? So as of this point, $43.5 billion worth of Ethereum is locked in various DeFi contracts, and that has grown considerably over the last year. And really what DeFi did was it made idle capital productive. So, people have been holding cryptocurrency since 2010, and in 2017, 2018, 2019, a lot of capital really came into the system. And I'm showing here a specific section of the total crypto market cap in the 2018 to mid 2020 timeframe. And you can see that somewhere between 100 to $350 billion worth of crypto assets were sitting largely idle. And what we'll show and what really happened was DeFi allowed users holding their crypto assets to do something productive with them, to earn a return on them. And that is really sort of what kicked off what's being called DeFi summer last year and the continuing rise. So to give my definition for what a DeFi product really is, and this is just personal, so feel free to disagree, but for me, a DeFi product is something that is a permanently deployed, credibly neutral application allowing users to permissionlessly exchange assets or risk. I've often heard finance described as all finance is effectively the exchange of assets or the exchange of risk. And for DeFi, I think what's really important about it, and I think understood by people in the space, but not talked about very much, is the fact that these applications are out there forever, right? As long as the underlying network that they are running on is still live, those contracts still exist. The functions can be called, the logic will execute. So these are permanently deployed, and the idea would be credibly neutral. And in the reality of that is complex. But over time, many of these applications get to the point where there's no governance at all. And as a user, you know that there's no third party that can interfere with the running of a specific contract. Okay, so let's get to one reason DeFi is different and why it has captured so much attention, and that's really that the assets themselves or the projects themselves generate cash flow, and that's typically it's done in several ways, and the recipients of those cash flow might be different people. So they may be holders of a token, they may be actual participants or users of the product that aren't holding a specific token, but fees that are generated based on the use of these protocols do flow to users, and that is something that when you go and talk to actual capital markets people, they've had a hard time understanding how to value crypto projects because it's so different from what they're used to. Typically, if you look at a typical L1 crypto asset, valuing that has been difficult, but you can go and say, look at Uniswap and look at the cash flows that are being generated over time, and they can plug that into a model and generate a value for it, right? So cash flows equal valuation, and DeFi has started driving that reality and made institutional investors wake up as a result. Okay, so we don't have time to talk about all of these DeFi use cases. This would be a 300-slide deck, but I do want to go into a little bit more detail about lending and DEXs, or what I'm specifically talking about automated market makers in that case. But it's important to know that DeFi actually does approach a whole bunch of different use cases. So stablecoins, many of you are already aware of those, and Bill did a Pillar series talk on stablecoins a couple months ago, synthetic assets, derivatives, and then an emerging class of asset managers. So put your assets in one place, and then they will do all the complicated logic for you to figure out where you can get the best return, that sort of thing. There's more categories than I'm listing here, but this is a useful way to group different DeFi projects. All right, so let's dig into lending a little bit. And as I said at the beginning, the goal here really is not to make sure that you understand everything that you possibly could about how lending projects are built, but I want to go deep enough so that you understand some of the mechanics, talk a little bit about terms that you've heard in the industry so that they connect to something when you hear them again, and then give you a couple terms to Google or things where you could explore further if you're interested. So to start with, what are the actual use cases for borrowing, right? What problems is this actually solving for users? And I sort of summarize this into four. The first, and this, I'm guessing this was the primary one to start with, is it allows users to get liquidity on their crypto assets in dollars, for example, without having to sell them, right? So when you sell, if you're holding Ethereum or any other crypto asset and you sell it, not only do you lose exposure to that asset, if it keeps going up, you're no longer part of that, but you also potentially trigger capital gains, right? And well, you definitely trigger capital gains. You may trigger short-term, depending on how long you've held it. And that's an important thing that users want to avoid. So by borrowing against their crypto assets, they can actually, I could borrow USDC in the flow that I show here, borrow USDC, send it to Coinbase, convert USDC to US dollars, send to my bank account, and then live my life, right? So I can actually get dollars out of the growth of my crypto assets. So that's use case one. Use case two, which again I think is driving a lot of borrow demand, is levering up. And this is a standard thing that in finance you are you often see. And apologies if my Keybase notifications are coming through, but leveraging up means taking a borrowed position and increasing your holdings, right? So in this case, I would supply Ethereum to a lending protocol, borrow USDC against my Ethereum, and then use that USDC to buy more Ethereum. So I'm taking on more risk. I now have a borrowed position and I'm a little bit more exposed, but this is a way for users to get more exposure if they're extremely bullish on a particular token. The third use case is native shorting of crypto assets. So in standard finance, if you're holding a stock, and say you're doing it through Fidelity or something like that, Fidelity will lend that stock out to anyone that wants it for a certain rate and allow them to sell it and buy it back lower, or that's their hope anyway, to profit from the stock going down. And those are the internal mechanics of how shorting works. And these lending and borrowing protocols allow users in the crypto sphere to natively short something. So if, for example, I think Ethereum is going down, I could borrow Ethereum from a lending protocol, sell it in the open market for USDC, hold that USDC for some period of time. And then if I'm right, when I buy ETH back at a lower price, I have to spend less USDC for it. I can return the ETH, repay my debt, and I keep the difference, right? So that is the mechanics of how shorting works. And then the fourth I've grouped into areas that I'm not going into, which are crypto-specific use cases. So flash loans, that's something I'll talk about briefly in other places. Governance, which really is sort of more governance attacks. There's additional things that you might want to use this for. Okay, so let's talk about the mechanics of how these lending protocols actually work. And the first thing to think about is that lending in crypto in DeFi for a number of reasons is a peer-to-pool model. And what I mean by that is, as a lender, as somebody that is supplying assets to the protocol, you're not choosing specific borrowers. You are lending to a pool of capital. So if I'm lending, if I want to lend my Ethereum out, I am lending Ethereum to a pool of Ethereum that's grouped with all the other lenders, right? And similar, when I'm borrowing Ethereum, I'm not borrowing from somebody specific, I'm borrowing from that pool. And that's an important dynamic that's true throughout DeFi for a few reasons, but it does factor in here. The second thing to think about is that all of the primary lending and borrowing protocols are over collateralized, which means that if I want to borrow something from the protocol, I need to have at least as much of that. I need to have at least as many assets supplied to that protocol. And so that means that, for example, in your normal life, you may want to borrow to go to school or something like that. That is not an over collateralized loan, right? You are borrowing against your future earnings, and what you're we're collateralizing effectively is trust that you are going to be able to repay that in the future. We'll talk about the mechanics of liquidations and things like that relate to the over collateralization in a later slide. And then there are some supporting factors that help these protocols operate. So price oracles are important. There is a separate group of liquidators, which again we'll talk about. And then beyond that, and I've taken this screenshot from Aave. They're integrated applications, so external protocols might be choosing to borrow and lend assets. Okay, and just to show you what a UI might look like for one of these applications. So the last slide was from Aave. This one is from Compound, two of the leading lending protocols. You can see here that I've got two markets. So they show supply markets over here and borrow markets over here. And they're different rates, right? So if I'm supplying, in this case, basic attention token, I'm only earning a 1.3% return on that per year. If I'm borrowing it at a much higher rate, 8.52%. And we'll talk about why those rates are so different in the meantime. But part of that is there's a spread that the protocol itself earns, and that gets back to these protocols earn fees. It's real cash flow that is understandable to institutional investors. As a user, I may have supplied multiple assets down here, and that will all go into my supply balance. And based on the over collateralization requirements, that's going to turn into a borrow limit for me. So I can borrow a certain amount, and below that amount, I'm fine, and it'll show me how close I am or how at risk I am to being liquidated. But that's sort of how it's structured. And again, I don't want to go too deep into this, but just to give you a sense of what this looks like for one particular application. And again, this is just a given front end for it. There could be multiple front ends. Okay, so I've mentioned liquidations a few times. So let's talk about how that actually works. And again, this is from the Aave documentation. In this case, there's a loan here that I'm showing on the left side, and the collateral that's required for that loan, again, it's over collateralized. So there's more required in collateral than there is for the loan. And this is denominated, for example, in US dollars. So, the collateral might be Ethereum, the loan might be USDC, it can be different assets, but you convert both to one specific asset, in this case USD, to understand the difference in relative value. So this line here they're calling it the liquidation value here. Sometimes that's called liquidation threshold or minimum collateralization ratio. You see these terms a lot. They all effectively mean the same thing, which is that if the collateral value falls below this line, then a liquidation event occurs. And a liquidation event is the protocol controls the collateral that you have in the system, and is able to sell it on your behalf. So it goes and sells some portion of your collateral to pay back your loan. And that's how the protocol is able to make sure that it doesn't get taken advantage of, right? The whole goal of these protocols is to be permissionless, to allow anyone to take a loan out, and they don't even know who it is. The way they manage that is they don't care who you are. All they care about is that you've put enough collateral up in the protocol, and that if certain conditions get met, the protocol has a way to liquidate and make sure that it stays whole on the loan. So that is the mechanic of liquidation. How it actually sells the assets, who buys them, those details vary. And at Agoric, we're working on mechanisms there as well. But at a high level, this generally works the same for all the over-collateralized lending protocols. Okay, and so I showed before for basic attention token, there was a massive difference between the rate that was supplied, the rate earned by suppliers, and then the rate that it costs to borrow. And the question is, how does that rate get calculated? And again, this is up to the protocol, but both Aave and Compound and other lending protocols do this similarly, which is the protocol has a certain amount supplied for a given asset. And then let's just stick with Ethereum as that asset. And when there is not a lot of borrow demand, the rate is lower. And they just have a function that basically says, what is the utilization rate of that asset? So I use borrow demand just now, but really its utilization rate is the rate of borrows versus the rate of supply. So when utilization is really low, they want to stimulate more borrowing, so the rate is lower. But as utilization approaches 100%, it typically hits a sort of a inflection point where suddenly the rate gets higher much faster. And that is to incentivize people to pay back the debt that they have taken out, because the protocol needs to make sure that it has enough for people to withdraw, right? So if I have supplied Ethereum to a lending protocol, I expect to be able to withdraw that from the pool whenever I want to. And to be able to do that, the protocol needs to have Ether available to me, and therefore there needs to be enough sitting around waiting. And it incentivizes that by making the rate higher. So again, these are just the mechanics. This is how this works to allow it to fluctuate without needing human intervention, right? So the utilization rate determines how that happens, and these curves are different in most of these protocols. These curves are different depending on the asset. Okay, so I said that one of the goals here was to talk about terms that you see in the industry, and one that has been seen a lot is yield farming. And really, it just comes from the idea that I've mentioned 2 lending protocols. You can imagine there's a whole bunch of additional protocols doing similar things. They may have different rates that you could earn for your Ethereum or your USDC or whatever asset it might be. And the term yield farming just came from the idea that as a user, I might want to move my assets quickly depending on who's paying me the best rate, who's paying me the best yield. And this metaphor got stretched a whole lot. People started talking about rotating crops. I'm just a humble farmer, that sort of thing. That's really where all this came from, is just the idea that you can get different yields and you want the best one at all times. You also may think, well, what if I just built something that would automate that for people, right? For myself and for other people. And that is exactly what Yearn Finance was. So Yearn Finance launched in this last summer, I think somewhere around July, and is now over $1 billion valuation, largely just based on automating this function for users and saving on gas. So there have been others as well. Okay, so this is the end of the lending section, but as I said, this is really just scratching the surface. If you're interested in lending, either just generally or if you want to build a product here, there's a few things that you should look into. So first, I skimmed across flash loans. It's a really interesting innovation that is specific to synchronous blockchains like Ethereum. I didn't talk about minting versus supply models. So in these examples, I've been talking about supply models where for every asset that's borrowed, it had to be supplied by somebody else. There are also minting models of lending, which is more like MakerDAO, where you contribute assets and then the protocol actually mints a new synthetic asset. In MakerDAO's case, it's DAI, which then you can use, and that is treated as a debt position. So a lot of the mechanics are very similar, but the fact that it doesn't need to be supplied means that there are differences there. And that again is the model that Agoric will use with some variations in our treasury as well. Some open active areas. So it doesn't mean nobody's working on these, but it means that at least to me, it doesn't seem like there are clear leaders yet. Under collateralized lending. So figuring that out is difficult, but would be a huge boon to the DeFi economy, right? If you can actually lend to people based on reputation successfully, that would supplant a whole bunch of traditional finance. Stable rates. So Aave does offer stable rates, and there have been some protocols that have launched with that. But right now, I showed that utilization curve. Those rates vary, right? So if you take a loan out and you're holding it for several months, your rate will change during that time, and it's hard to know what you will pay over the course of those months. And that's a difficult thing for users. So figuring out how to manage stable rates is important. And then tranched risk, and this may or may not be true to a true lending thing, but in finance, you often see bonds get listed with tranched risks, so that one group might take all the risk of default up until a certain point, and they are the riskiest here and they earn the most, that sort of thing. It allows you to take one stream of cash flows and separate it into multiple different products. So again, people are working in these areas, but it still is open, and it's something that you should, if it's something that's interesting to you, you should look into it. All right, I'm going to pause for a minute. I see a few comments coming in here. If there are questions, please do send them along. I'll see comments in YouTube, and please do stop me if you've got any questions. Otherwise, I'm gonna keep rolling on automated market makers. All right, let's go. Okay, so automated market makers, and I'm going to go back to this slide after I talk a little bit about them. But the goal here really is just to show you it's going up and to the right, right? So there are the growth in automated market makers has been significant over the course of the last year, and this is just volume being processed by the primary ones. So I'll come back here to talk about individual AMMs. But if we to frame what an automated market maker is doing, it's useful to think about it as in contrast to how you're used to looking at an order book if you buy your own stocks or something like that. So the usual exchange model is called a central limit order book, and the way that works is each line here is a specific price. And there may be multiple orders that people put in. So if you're familiar with putting in a limit order, I might want to buy AMMs, for example, and if it's trading at $20, I want to put my limit order in at $19.50 or something like that, with the idea that if the price drops a little bit, I'll get filled, and I will now have saved a little bit versus buying it directly at 20. That might be the way a user thinks about it. Institutions do this in a much more regimented and sophisticated way, but an order book is just saying, what are all the orders to buy and what are all the orders to sell? And if any of them match up, I'm going to execute them. And that is so. And what that means is that every time you are buying, somebody is selling, and the exchange is just matching you with some other real entity at that time. And so the difference with an automated market maker is that instead of one buyer and one seller, what you have is you have sellers effectively called liquidity providers contributing liquidity to a pool. And then you have buyers, which may come in at different times and are able to buy whenever they want to. So we'll go into a little bit more about how the actual mechanics of this work, but it's really important. The real innovation for automated market makers was separating the need to have a seller for every buyer. Or at least in my view, that truly is what was revolutionary about it. So let's walk through an example, and I'm gonna try to introduce concepts sort of gradually, but this is specific to an XY curve automated market maker. I'll talk a little bit more about what that means. So I've got three groups here. I've got a liquidity provider, I've got the pool itself, which is the AMM, the automated market maker, and then I've got a trader. So the pool starts with 100 ETH and 100,000 USDC. This is assuming $1,000 per ETH. And again, this is just arbitrary. The pool will have to be seeded by somebody. It doesn't just get assets, right? But in this example, this is where it's starting. And then you have a concept here called K, which I'll talk about a little bit. But for now, what the pool knows is that it has 100 ETH and 100 USDC, or 100,000 USDC, excuse me. Now, a liquidity provider comes along and say, that's you or me, and I've got 1 ETH and 1,000 USDC, and I can contribute that to the pool. And what's important is I have to contribute this in the ratio that it currently exists in the pool. So right now, there's 1,000 USDC for every ETH in here, 100,000 to 100. And so I need to have 1 ETH and 1,000 USDC if I want to put in, I could do 500 USDC and half an ETH, but the ratio has to be equivalent. So I contribute it. There's now 101 ETH in the pool and 101,000 USDC in the pool. And so as a result, I have 0.99% of the pool. You can see here, the price started at $1,000, and I'm using dollars as a convenience. Really, it's just 1,000 USDC per ETH. And after I've contributed, the price is still at $1,000. But now a trader comes along, and the trader says, I would like to buy 5 ETH from this pool. And what the trader doesn't necessarily know is what the price is they will get. The pool can tell them at the time they say, I would like to trade, or they could calculate it themselves if they know how much liquidity is in the pool. But for this purpose, let's say I just know that I want to buy 5 ETH, and I'm relatively price insensitive, so whatever price it ends up at, that's fine with me. I buy 5 ETH for 4 USDC, and you can see now that what happens after that is the ETH drops by 5, and the USDC increases by more than 5,000. And the reason for that is all the pool knows, the reason why it's called an XYK pool is the K is invariant here. So right now, K is 10,201,201,000. When the ETH changes, K has to stay the same. And as a result, you get what the USDC balance needs to be to make that true. So K can increase or decrease when liquidity is added or removed, and you see that here. But on trades, K stays the same, and that is what determines the price. So the elegance of this is that the pool only needs to know how much ETH it has, how much USDC it has, and what K is, or excuse me, and the curve that it is using to transform them, and K falls out of that. So that's all the pool really knows. It doesn't know anything about what the price should be. It doesn't really know anything. It just knows I'm holding these assets and I've got this curve to transform them. But what falls out of that is the price, because now there's a certain amount of USDC and a certain amount of ETH in the pool, and the price now is at $1,106.88. Okay. And I'm seeing a question come in. Does the user have an option in trading with a specific pool? And the answer there is, it depends on exactly what you mean by the question, but the answer is yes, right? So as a user going to Uniswap, for example, this pool is ETH and USDC. They have separate pools for all the different asset pairs that they need to use, and sort of. So sometimes they might route through multiple pools. So like, for example, if I want to trade ETH to some other asset that they don't have a specific pool for, it might go through 2 pools. But you have a choice of where you want to trade. The curve, though, is specific to the protocol. So, or at least in most cases. So in Uniswap's case, all their curves are XYK curves. And that is true for anything that is done in that protocol. So you can't necessarily say I want to trade these same assets with a different curve. That has to already exist, and the liquidity providers have to agree to add their assets to a specific pool with a specific curve. Okay, and just to fill out this example here, in this case, the user now wants to withdraw their liquidity, and remember they had 0.99% of the pool. They withdraw 0.99%. And now they're taking out something different than what they put in, 0.95 ETH and 1,052 USDC. And that is because trades occurred, the price changed. And so their ratio has changed as a result of those trades. And that gives way to the idea of impermanent loss, which we will talk about. Okay, I'm going to pause here for any additional questions before I go forward. And again, this is a bit of a toy example, but hopefully this shows the mechanics of how an AMM actually works. Okay, so impermanent loss, probably the worst named concept in DeFi, and that's a difficult competition, but it has confused more people than it has informed. But the term remains, so I'm going to explain it as impermanent loss, and I apologize for that. I think so. Dean, our CEO, likes to say, give me more of whichever of these tokens does worse. And that largely does explain impermanent loss, right? So more technically, as an LP, as a liquidity provider, you are short the relative volatility between the tokens you provide. And to make that more concrete, in this case, I added 1 ETH and 1,000 USDC. The ETH price went up as a result of trading. And here I'm just showing one trade, but there could be thousands, hundreds of thousands of trades before I remove my liquidity. But all that's important is that the result of those trades was that the ETH price went up. And then when I withdraw, I'm withdrawing less ETH and more USDC. So ETH price went up and I get less of it. USDC versus ETH went down and I get more of it. And that's really the mechanics of the liquidity pool, right? You are withdrawing the equal value in USD or any third price of the assets that you put in. And really what that means is as ETH price goes up, you're providing liquidity for our traders. And so traders are, get this right, as the ETH price goes up, traders are buying ETH, which means removing ETH from the pool and giving you the other token, USDC. So the pool weight will have less and less ETH and more of the other token. And through the nature of you having provided the sale to them through that rise, you actually lose relative to holding both those assets alone. And that's really what impermanent loss means, is as the asset prices, which when you give them, they are equal because they have to be, as the asset prices diverge, the more they diverge, the more your returns will lag versus just holding the assets themselves. However, the counterpoint is that you earn fees. So I because this is a toy example, I didn't add it here, but in this trade, there is a 0.015 ETH fee because I just picked Uniswap. Uniswap has a 0.3% fee, and that gets added to the pool over time, which as an LP, you get a share of. So what you are betting when you are providing liquidity is that the losses of the impermanent losses, but the lag that your portfolio has based on having provided liquidity and selling to people that are buying will be less than the fees that you earn. And that really is the position you have as an LP. So hopefully that's clear. Again, ask questions if this isn't, but impermanent loss really just means as the prices diverge, you will lose versus holding. Okay, so I talked a little bit about, I guess I haven't gotten there yet. One of the use cases of AMMs is liquidity mining. And this is sort of a culture moment, a term that is used often in DeFi. And really what that means is as a new project launching, one of the problems that AMM solved was being able to have people buy your token, right? If you are a new project and you want to launch, and it's important that your token is trading and a token is an important part of how your users interact with your system. Your users need to be able to get the token. And in the past, that meant people had to be able to buy it off an exchange. And actual exchange listings, especially for unknown projects, are extremely expensive. So that's a huge barrier. That was a huge barrier to launching a new project. But now, because of Uniswap, because there are, and Sushi and other AMMs, because there are these permissionless AMMs, you can have your users create liquidity pools for you. And the way you incentivize that is you give away your token to people that are doing that. So in many cases, a project will launch and they will distribute their token in part or entirely just by people bringing their liquidity into the system. So for example, a lending protocol might want you to contribute ETH so that ETH can then be borrowed out. They might distribute their token to people that contribute ETH. So you bring in your ETH and you get some of their native governance token. There is a separate pool that really is what liquidity mining is, where you get that governance token and then you supply that governance token with, for example, USDC to another pool so that people with USDC can just buy your token directly, right? So the way to get the token to begin with is you supply some liquidity in some other token, and you gradually get the governance token of the project. But then you can supply that governance token and allow other people to buy it. And that is the liquidity in liquidity mining. So projects will launch, they will ask you to please supply our token in a pool with USDC or with some other asset, and we will reward you with additional tokens. So that, there in DeFi parlance, that's pool 1 and pool 2. And a liquidity mining campaign, to be successful there, really what you're trying to do is you're trying to bring attention to the project. You're seeding initial liquidity so that that pool 1 where people are bringing Ethereum in so that it can then be lent out. Hopefully that's doing something important for your actual product. That's an important part of this. Some projects do liquidity mining without actually having a value for the liquidity, which is a problem. Your goal is to also broadly distribute the tokens. You want a lot of people owning that and have a broad community base. And then it also kickstarts the actual price discovery for your token itself and trading. And eventually the hope is that the liquidity that is being put in an AMM that you are incentivizing starts is there sort of more permanently even after your incentives end. I realize that I am significantly over time here, so I'm gonna roll a little bit faster. As a culture moment, pool 2 farmers, that's sometimes known as the death pool. If you are new to DeFi, just know that by entering pool 2, which is the governance token and some other token, you are exposing yourself to a pretty significant amount of risk. Something important to know. If you're interested in taking AMMs further, look at differing curve models. So StableSwap was released by Curve, and that now is one of the largest AMMs. So this maroon color is Curve. That was just an innovation in the XYK, versus XYK. They did something different. And again, no time, but please do look into that sort of thing. That's really important. People are working on capital efficiency of liquidity, mitigating impermanent loss if they can. There will always be impermanent loss in AMMs, but there are potential ways that you can either compensate users for it or attempt to help mitigate it. And then combining AMMs with order book functionality. All right. So let's talk a little bit about DeFi and Agoric. From our standpoint, we talk a lot about the technical properties of our system, the security properties, why we think building in Agoric makes a lot of sense for those reasons. But I think really what it boils down to is just being able to build faster and maintain the level of safety you need. So there's a whole bunch of reasons for that. But the frameworks that Agoric provides are tailor-made for building DeFi products, right? That we are we have frameworks for assets, asset exchange, being able to offload the exchange of assets between parties to a trusted protocol level thing. And again, because this isn't a talk on Agoric, I'm not gonna go deep on this, but really what this all adds up to is being able to build faster. Our native protocol itself has lending and AMM built in. So as an Agoric token holder, you are helping to both secure the network, but also secure the economy. And because of that, there will be components that as a third-party developer, you can reuse that we are using at our protocol level. So you can be sure to build on top of those, understand the frameworks we're using, and there will be a lot of examples for you as a builder. And beyond that, it's something that we understand as a team because it is core to what we're doing. Okay, so I want to summarize quickly thoughts on launching your project. So first off, obviously, make sure that you're solving a real problem. The challenge here is that is, there's tons of opportunity, but it is getting harder to solve a real problem because you have to know more about the market you're in. The ideas around I'm going to have a protocol where somebody can bring in assets and other people can borrow them. Those are already done, right? There are winners in those markets in large part. So you have to understand where the holes are, what they are not doing well enough. If they have a problem with their liquidation model, is that something you can fix? So I call out a couple recent examples here. Alchemist launched about a month ago, and their model is lending but no liquidations, or part of your loan pays off the other part. And again, it's small tweaks to the way these protocols function, but they make a big difference to users. So understanding the user behavior around this stuff is really important. Can you create a liquidity flywheel, right? Is liquidity actually driving something important for your protocol? Can you have liquidity coming in, driving better experience for users, driving more liquidity, driving better experience? Token distribution is a part of your product offering, so think about that. Think about how broadly you want it to go. Think about how you want that distribution to happen. And then, I should have added governance. Community building and governance is part of your product offering too. So in my definition early on, I talked about credibly neutral protocols. And the reality is when you launch, nobody has credibly neutral means there's no governance or extremely minimized governance. But it is impossible to do that and a bad idea to do that when you first launch. So the question is, what is your pathway to get to that? And how do you communicate that to your community? And are they a part of it? Are they bought in? If you're going to have decentralized governance, do you have people as part of your community that will do a good job with it, right? That community building is truly important. And I apologize for rushing, but I just want to make sure we're good on time. So finally, just summary thoughts. DeFi, it provides real value for users. There are a lot of language issues and concepts that are very specific to DeFi that make it seem unapproachable. But when you really kind of dig in, the concepts aren't that hard, right? It's primarily easy algebra or just a term that is unnecessarily specific. And so it's not as impenetrable as it may seem. And as a reminder, just succeeding here requires increasing specialization now. You need to know your market better. You need to be able to build faster. And that's in large part why Agoric is such an important piece of the ecosystem, because we enable you to build faster. And if you're working on under collateralized lending and somebody on Ethereum is working on under collateralized lending, we believe you'll be able to get there first. So with that, I think I'll end, but I'm happy to spend a minute or two waiting for questions if there are. Thanks. All right, well, I really appreciate the time. Please do join our Discord if you haven't already. If you have questions here, feel free to reach out to me directly or any of us in Discord, and we're looking forward to seeing you soon.